Over here you can see the breakdown of Apple's cash flow statement. It starts with the net income, how it builds into cash from operations, and how this is allocated or spent in the different ways. In order to get the cash from operations, you first start with your net income and you sum back all non-cash charges that you've had, such as depreciation and amortization, stock-based compensation, and other expenses. Now from here you can take very different approaches in order to calculate whether a company is a good buy or not. One of the key things that we'll be focusing on here is regarding free cash flow. Free cash flow at the end of the day, if you're an investor, is what you will get from a company because it is the amount of cash that they're actually able to spend on dividends, share buybacks, investing in their business, and other type of allocations. And the formula for this is taking your cash from operations, so that $122 billion that we have just discussed, and you minus the capital expenditure. And this is the first item on the right hand side, which equals $10.7 billion. As we can see, a very big chunk of this free cash flow is actually used for stock buybacks, where they spend almost $90 billion in 2022 just for buying back shares. The second largest item is of course paying out dividends, where they spent around $15 billion. I've always wondered, there is a very large community in the world surrounding dividend growth investing, or just dividend investing in general, because they're very attractive since they generate a lot of income for the investor. However, on the other side, stock buybacks aren't that popular. And in this case, the largest company in the world is spending so much more on stock buybacks than on dividends. Do companies that offer mainly stock buybacks perform a lot better than companies who offer mainly dividends? That's what we'll be checking out today. But before checking that out, we first have to dive deeper into what free cash flow is. It's all the cash that a company can invest and which can be mainly spent in 4 different ways. The first one is reinvesting in the business, where actually not all companies should reinvest their free cash flow that they generate into their businesses. You can think of very large companies which are facing slowdowns, such as for example tobacco companies. They don't have a lot of room for growth, and this is why those companies have such high dividend yields and spend a lot more on buying back their shares. However, on the other hand, companies which have very high growth rates should potentially invest almost all of their free cash flow back into the business to accelerate their growth. Over here, we can see the value creation depending on the return on capital employed that a company can obtain, where we're estimating that the cost of capital equals 8.5%. But what is the cost of capital? Well, this can be thought of how expensive it is for a company to finance any type of operations. This is usually the addition of how expensive it would be to take out a loan or how expensive it would be to actually raise equity. And in general, the rule of thumb is that in order for a company to create value, their return on the capital employed should be higher than the cost of capital. So in this chart, very easily, anything that is below 8.5% actually destroys value, and anything that is above 8.5% creates value. So our strategy is just looking at the return on capital employed, and if this is lower than the average cost of capital, then the business is destroying value by reinvesting their free cash flows into their business, and they should instead either repay their debts, pay dividends, or buy back shares. So the second great use of free cash flows is to repay companies' debts. In the recent past, we've had an environment of very low interest rates, and this has allowed companies to become extremely over-leveraged. Here you can see the average S&P 500 long-term debt to EBITDA from 2001 to 2022. And at the start of the period, this was around 1.46. Well, currently it is almost double that. It rose to around 2.43 in 2018, and now we're currently sitting at 2.22. What this means is that companies should now start to spend a lot more money that they have been spending for the past 20 years in actually repaying their debts. The third great thing you can do with your free cash flows is to pay dividends. And this is actually the most common way of distributing your free cash flow to your shareholders. And here you can see the global annual dividends paid in $1 trillion since 2009 to 2023. It has been growing at a very fast CAGR, and it's extremely popular. Of course, special dividends are those dividends which are not paid consistently. They can increase from one year to the other. For example, Costco, maybe in 2025, may decide that they have had such a great year that instead of reinvesting in the business, they just prefer to pay that as an extra dividend. And now, last but not least, they can buy back shares, which is a way of redistributing the free cash flows, which has been growing at an even faster pace. As we can see over here, the global share buyback expenditure in $1 trillion as well since 2016 to 2022. Buybacks have been growing at a way faster pace. And the good thing about buybacks that dividends don't offer is flexibility. because with dividends you have to be paying them every single quarter. With buybacks, you can just do it whenever you believe that your stock is undervalued. But is any of these two strategies actually better than the other? Do companies that pay dividends perform better than those who buy back shares? There's not such a clear difference. Over here we can see the average yearly performance by strategy from 2006 to 2022. Of course, here we're comparing to indices because it's the easiest way that we can do this analysis. We're comparing the S&P 500 Dividend Aristocrat Index, and then we have the Nasdaq US Buyback Achievers Index. There are various issues with this comparison. The ideal would be to do a much more extensive discussion. But for sakes of this quick analysis, it is all that we need. We can see that by total returns, the S&P 500 Dividend Aristocrat Index actually outperforms by around 0.7 percentage points. However, there is another important KPI that this actually has an effect on, which is volatility. Dividend aristocrat companies are very large blue chip companies which have been in business for a very long time, and their price of their stocks is known for being extremely stable. This can be seen by their 14.5% volatility, which is a lot lower than when you compare it to the buyback companies, which have a volatility of around 17.1%. Dividend companies actually look like they're slightly better off than buyback companies. However, I believe that it's not fair to actually compare the two strategies, since I believe that the best strategy is to actually combine both. This is exactly what Apple does. They distribute dividends every single quarter, and although they could spend a lot more in dividends, what they do is that they just wait for the correct timing, and when their stock dips and they believe that it is actually undervalued, they come in with the big share buybacks in order to get more return on every single dollar that they're spending on redistributing the cash flow back to their shareholders. And this is very important, because there are many companies which try to consistently buy back shares, and although this isn't bad, it is a lot better when they just do accumulated purchases whenever their stocks are trading below intrinsic value. Now, these two strategies have very different advantages. For dividends, of course, they offer a regular income stream for investors. They allow you to compound your investment through the dividend reinvestment program, where if you reinvest every dividend that you get from a company and you use it to buy more stocks of that company, you will get what is known as the snowball effect or the compounding effect, which will allow you to enhance your returns over the long term. Dividends are a sign of profitability and stability. And finally, this also offers lower price volatility, as we have seen. On the other hand, we have advantages of share buybacks, where you can get a way greater return for idle cash. This can boost EPS and shareholder returns, because at the end of the day, EPS is what actually drives performance for stocks. Next, you will be able to raise the investor confidence, since they will be seeing that you're buying more of your own stocks, meaning that first of all, you believe in the long term of your company, but second of all, that you believe that your shares are currently trading at under intrinsic valuations. This gives your free cash flow management a lot of flexibility, as you don't have to be committed to this. You can do this whenever you please, as long as you have the correct approval from the board. But overall, my investing strategy, I'm not focused on either of these. I believe that it is more important to just focus on other fundamentals, such as the growth rates, the return on capital employed, the margins, and I believe that dividends and share buybacks are like the cherry on top, where they usually come hand in hand with great management or with a great company. So thank you for watching. As always, this has been the Cashflow Compounder. Join the Fairy Patreon for extra content, and I'll see you in the next one.